Stop for 1 second before you keep watching. If you clicked on this video because you have extra money sitting in your account at the end of the month, and you genuinely do not know whether it should go toward your mortgage or into the stock market, I need to tell you something most people never hear. You are not behind, you are not struggling. You are, statistically speaking, part of a tiny minority of Americans. Right now, the average American household saves a shockingly small percentage of what it earns. The United States gross savings rate sits at just 3.6%. That means for every $100 the average household brings home, only about $3.60 actually gets saved or invested. The rest is gone, spent, absorbed. If you have a real, meaningful leftover dollar every single month, a dollar with a genuine choice attached to it, mortgage or market, you are already standing in the top 3.6% of savers in this entire country. But here is the problem. The choice you are about to make, the one that feels simple, is actually one of the most misunderstood decisions in personal finance. And the bank is counting on you never understanding it. Here is what almost nobody tells you about a 30-year mortgage. For the first 20 years of that loan, on every single payment you make, the bank takes home more money in pure interest than you actually build in home equity. 20 years. That is not a typo, and it is not an exaggeration. It is how the math is built from day one. You could pay your mortgage faithfully for 2 full decades, watch your kids grow up, maybe even watch your house double in market value, and still mathematically the bank has been eating a bigger slice of every single check than you have. Most homeowners never see this because nobody ever shows them the actual breakdown. They see one number on their statement, the payment, and they assume it is split evenly between paying down the loan and paying the interest. It is not even close to even. And once you see exactly how uneven it really is, you will never look at your mortgage statement the same way again. I'm going to show you the real numbers in a minute, the ones your bank never puts on a billboard. But first, let me tell you who I am and why I spend my life digging into numbers like this. My name is Dave Marshall. I'm not a financial advisor trying to sell you a product, and I am not here to tell you what to do with your money. I spent years working around loan structures and investment portfolios, watching regular people make six-figure decisions based on gut feeling instead of arithmetic, and I got tired of watching people lose money simply because nobody ever sat them down and showed them the actual math. That is what this channel is. David Marshall Finance is where we take the confusing, intimidating side of money, mortgages, interest rates, compounding debt, and we break it down until it is simple enough that you could explain it to a friend over coffee. If that sounds like something you want more of, hit subscribe right now before you forget, because today's video is going to change how you think about the biggest debt of your life. Now let us get into the numbers, because what I am about to show you is going to make you look at your amortization schedule differently for good. Let us use real numbers because vague numbers do not change behavior, exact numbers do. Say you take out a fairly typical mortgage today, $400,000, 30-year fixed 7% interest. Your monthly payment comes out to $2,660. That is the number on your statement every single month for 30 years. It never changes. But what is hiding inside that number changes dramatically, and almost nobody ever looks. In month 1, out of your $2,660 payment, $2,333 goes straight to the bank as pure interest, pure profit for them. Only $327, less than an eighth of your payment, actually goes toward paying down your loan, your principal, the part that is actually yours. Read that again. In your very first payment on a brand new home you just committed 30 years of your life to, roughly 87% of your money evaporates into interest. This is called an amortization schedule, and it is deliberately, mathematically front-loaded. The bank front-loads the interest because they get paid first. That is not a conspiracy theory, that is literally how amortization math works. Every single payment you make slightly shifts the ratio, a little less interest, a little more principal, but that shift happens so slowly that most homeowners do not feel it for years. Now fast forward, not 1 year, not 5 years, 20 years, 2/3 of the way through your 30-year loan. You have made 240 payments faithfully on time every single month. Surely you would expect to owe less than half of what you originally borrowed, right? Wrong. At year 20 on that same $400,000 loan, you still owe $229,000, 57% of your original balance. You are 66% of the way through the term of your loan, and you still owe more than half the house. That is the 20-year bank squeeze I mentioned at the start of this video, and now you understand exactly why it happens. And if you let that loan run its full 30 years without ever paying a single penny extra, the total interest paid to the bank over the life of that loan is $558,000. On a $400,000 loan, you will have paid more in pure interest than the house originally cost. Now here is where it gets interesting, because knowing this does not automatically mean you should throw every spare dollar at your mortgage. In fact, for a huge number of homeowners watching this right now, doing that would actually be the wrong move, and I am about to show you exactly how to know which category you fall into. This is the single most important concept in this entire video, so pay attention. Whether you should pay off your mortgage early or invest that extra cash comes down to one number: your interest rate, just that. If your mortgage interest rate is low, somewhere between 2.5% and 5%, the math overwhelmingly favors investing your extra cash instead of paying down the loan faster. Why? Because historically, the S&P 500 has returned an average of around 10.26% per year before taxes. And even after accounting for taxes and fees, you are realistically looking at 7 to 8% landing in your pocket over the long run. If your mortgage is costing you 3% and the market is realistically handing you 7 or 8%, every extra dollar you send to your mortgage instead of the market is a dollar quietly costing you the difference. The lower your mortgage rate, the more sense it makes to invest. That is not opinion, that is arithmetic. But flip the scenario. If your mortgage rate is high, somewhere between 6 and 8%, the entire equation flips upside down. Paying off that mortgage early is no longer just emotionally satisfying, it becomes one of the smartest financial moves available to you, because every extra dollar you throw at a 7% mortgage is giving you a guaranteed 7% return. Not an average, not a projection, guaranteed. There's no other place in your entire financial life where you can get a completely risk-free return like that. The stock market can drop 30% in a single year. Your mortgage payoff never will. Paying down a 7% mortgage early is mathematically identical to finding a risk-free investment paying 7%. And because it is debt, that return does not get taxed either. It is a tax-free return equivalent, which very few investments anywhere can claim. So the real question is not mortgage or market in the abstract. The real question is this: what is your rate? Because your rate decides which side of this equation you are standing on. Now, before we move on, I have to address the objection that always shows up in my comments the moment I talk about mortgages. Someone always says, "But Dave, what about the mortgage interest tax deduction? Doesn't that change everything?" Here is the honest answer. For most homeowners today, it barely moves the needle. Since the standard deduction was raised substantially a few years back, the majority of American households no longer itemize their taxes at all, which means the mortgage interest deduction does nothing for them. Even for the households that do itemize, the deduction only reduces your taxable income by the interest amount. It does not hand you back the full dollar. It shaves a few percentage points off your effective rate at best. It is real, but it is nowhere near large enough to flip a 7% mortgage into a bargain. Do not let that deduction talk you out of doing the real math on your actual rate. And once you know which side of that rate threshold you are on, if you land on the payoff side like millions of homeowners with rates above 6%, there are exactly 3 weapons you can use to attack that mortgage. And one of them can shave nearly 7 years off your loan without you even noticing the extra money leaving your account. Strategy number 1 is called the biweekly payment hack, and it is criminally underused. Instead of making one mortgage payment a month 12 times a year, you split your monthly payment exactly in half and you pay that half amount every 2 weeks. On the surface, that sounds identical to a monthly payment. It is not. Here is the trick hiding inside the calendar. A year has 52 weeks, not 48. So paying every 2 weeks means you make 26 half payments a year, and 26 half payments add up to 13 full payments, not 12. You have sneakily made one entire extra mortgage payment every single year without ever feeling like you did anything extraordinary. You did not budget for it as a lump sum. You did not feel a big hit. It just happened because of how the calendar divides into 2-week chunks. On our $400,000 loan at 7%, this one shift, switching from monthly to biweekly payments, cuts your 30-year loan down to 23 years and 11 months. You pay off your house more than 6 years early, and in the process you save $134,000 in interest. $134,000 saved just by changing the rhythm of your payments, not the amount. Most banks will let you set this up directly, though some charge a small setup fee, so it is worth calling and specifically asking for bi-weekly payment processing, not just a generic automatic extra payment. Strategy number 2 is simpler and more flexible, just adding a fixed extra amount to your principal every single month. This is where a lot of people underestimate how much power a small, consistent number actually has. Let us say you add an extra $200 a month directly toward your principal, not your escrow, not your insurance, straight at the loan balance. On that same $400,000 mortgage at 7%, $200 extra a month cuts 6 years off your loan and saves you $126,000 in total interest. 6 years of your life back and over 6 figures saved from an extra $200 a month, which for a lot of households is one skipped subscription bundle and one fewer takeout order a week. Even if 200 feels like too much right now, this strategy scales. An extra $100 a month still makes a meaningful dent. Just cut those numbers roughly in half and you will be in the right neighborhood. The key with this strategy is consistency, not size. A small amount every month, applied directly to principal, compounds in reverse. It shrinks your remaining balance faster and faster, because every dollar you send early stops that dollar from ever generating interest again for the rest of the loan. Strategy number 3 does not require any monthly discipline at all, which is exactly why I love it for people who struggle with consistency. It is called the Windfall sweep. Every year, most people receive at least one lump sum of unexpected or semi-expected cash. A tax refund, a work bonus, a birthday check from grandma. Instead of letting that windfall cash quietly disappear into your checking account and get absorbed by everyday spending, you sweep it, all of it or most of it, directly onto your mortgage principal the moment it arrives. Because it is a one-time lump sum applied early in the loan, when interest is at its most front-loaded, it has an outsized impact on your amortization schedule compared to the same dollar amount spread out over 12 months. A single $3,000 tax refund, applied directly to principal in year 1 of a 7% mortgage, can eliminate months of future interest in a single move. Combine all 3 strategies, the biweekly hack, the extra monthly amount, and the windfall sweep, and homeowners routinely cut their 30-year mortgages down into the 15 to 20-year range without ever refinancing. But here is where I need to slow down, because so far I have only shown you one half of this story. I have shown you what happens when you attack your mortgage. I have not shown you what happens to the person who takes that exact same money and puts it into the market instead. And when you see these 2 paths sitting side by side over 25 years, the result might genuinely surprise you. Let me introduce you to 2 people. Not real people, but 2 entirely realistic homeowners, because I want you to see exactly how this plays out over a real timeline, 25 years. Call the first one Ryan Coleman. Ryan has an 8% mortgage, and every single month for 25 years, instead of sending extra money to his loan, Ryan takes $500 and invests it into an S&P 500 index fund. He never touches it. He just lets compounded growth do its work, month after month, year after year, through market crashes and recoveries, through good years and terrifying years. He never stops the $500, and he never checks the balance out of panic. Now call the second one Sarah Whitman. Sarah has the exact same 8% mortgage. Every single month for 25 years, instead of investing, Sarah takes that same $500 and throws it directly at her mortgage principal, on top of her regular payment, attacking the loan as aggressively as she can. After 25 years, here is what happens to each of them. Ryan, the investor, ends up with $473,000 sitting in his brokerage account. Liquid, accessible, still growing. That number comes from the raw power of compounded growth. An 8% average annual return compounding on itself for 2.5 decades turns roughly $63,000 of raw deposits into nearly $500,000. Sarah, the extra payer, does not have a brokerage account showing $473,000. What Sarah has is $188,000 in total interest saved, and a mortgage that got paid off years earlier than scheduled. Her house is fully hers, free and clear, faster than almost anyone she knows. Now here is the part that trips people up. On paper, in pure dollar terms, Ryan's strategy produced a much bigger number, $473,000 in liquid wealth compared to Sarah's $188,000 in interest saved. That is not even close mathematically. Compounded growth on an appreciating asset class historically outpaces loan reduction on a fixed-rate debt, especially at 8%, which sits right in that gray zone. If Sarah's rate had been higher, say closer to 9 or 10%, her strategy would have closed that gap significantly because paying off high-rate debt early becomes more powerful the higher that rate climbs. But at 8%, the market historically wins the pure math contest by a wide margin. So does that mean Ryan made the smarter choice and Sarah made a mistake? Not necessarily. And this is exactly where most financial content completely drops the ball, because they treat this like a pure math problem when it is not only a math problem. Paying off a home is not always a purely financial decision. Sarah's house is fully paid off. That means no matter what happens to her job, her health, or the economy, nobody can ever take her home away over a missed mortgage payment because there is no more mortgage payment. That is not something you can measure cleanly on a spreadsheet, but it is absolutely real. Financial planners call this the trade-off between peace of mind and mathematical optimization, and it is one of the most personal decisions in all of personal finance, because the correct answer genuinely depends on your own tolerance for risk, your own relationship with debt, and how you personally sleep at night. There are other practical angles too. A paid-off mortgage instantly improves your debt-to-income ratio, your DTI, which matters enormously if you are planning to apply for other loans, start a business, or qualify for anything that looks at your monthly obligations versus your income. Lenders love seeing a paid-off home. It signals stability. And for people thinking ahead toward retirement, walking into your 60s or 70s with a fully paid-off home, what a lot of planners call paid-off home security, removes one of the largest fixed expenses most retirees carry. No mortgage payment competing with a fixed retirement income is a genuinely powerful position to be in, one that does not show up as a dollar figure but shows up every single month as breathing room. On the flip side, Ryan's brokerage account gives him something Sarah does not have as easily: liquidity. If an emergency hits, if an opportunity comes up, if he simply changes his mind, Ryan can access that money relatively quickly. Sarah's equity is real, but it is locked inside her house, and turning home equity into usable cash usually means selling the house or taking out another loan against it, which brings its own costs and risks right back into the picture. So here is how I want you to actually use everything I just walked you through. Check your mortgage rate first, because that single number tells you which side of the threshold you are standing on. If you are sitting somewhere between 2.5% and 5%, the math is on the side of investing that extra cash. If you're sitting at 6 to 8% or higher, the math is on the side of attacking that mortgage, and probably attacking it hard using the biweekly hack, the extra monthly principal payment, or sweeping in Windfall cash the moment it lands. And if your number sits right in that murky middle, somewhere around 5.5 to 6.5%, that is genuinely a personal call between mathematical optimization and the peace of mind that comes with an empty mortgage statement. Here is what I want you to take away from everything we just covered. Your mortgage statement is not neutral. It was built from day one to front-load interest in the bank's favor, which is exactly why the first 20 years of a 30-year loan can feel like you are barely making progress, even when you are doing everything right. Understanding your amortization schedule, understanding principal versus interest, and understanding exactly where your rate sits relative to that 5 to 6% threshold changes you from someone reacting to a mortgage statement into someone actively directing hundreds of thousands of dollars over the life of that loan. Whether you end up like Ryan building compounded growth in the market, or like Sarah sitting inside a home that is completely permanently hers, the worst outcome is not picking the wrong one. The worst outcome is never running the numbers at all, and just letting that leftover cash drift into nothing, month after month, decade after decade, without ever making an intentional choice. You already told me something important just by watching this far. You are someone who has extra cash and actually wants to make an intelligent decision with it. That already puts you ahead of the vast majority of people out there operating on autopilot. Take 5 minutes this week, pull up your actual mortgage statement, find your actual interest rate, and run your own numbers using everything you just learned. If this video helped you see your mortgage differently, make sure you are subscribed to David Marshall Finance, because every single week I am breaking down exactly this kind of decision, the ones worth real money in plain, honest numbers, no jargon, no sales pitch. I am Dave Marshall, and I will see you in the next one.